All right. Thanks, everyone, for joining us today. This is Mia with Payroll Partners, and I see that we have several people that know Payroll Partners and possibly myself, as well as some newcomers, so we do appreciate and welcome everyone. I'm going to run through some quick housekeeping items, just to make sure everyone's logged on, and we give everyone a few minutes to get in and get situated. If you have not already seen, in the chat, we have posted several handouts that Elaine has provided us for the presentation that are going to be pretty helpful to you. So if you want to go ahead and take a moment and look at those, the handout notes titled slide notes are something that you might want to print out and take some detailed notes on as Elaine is going through some figures and things. There's also her biography, which we'd love for you to read through, her article that she wrote regarding the employee retention credit, and just a little bit of information about Payroll Partners as well. So feel free to click through those and download and print as you would like. If you're having trouble seeing or you're not seeing our screen, you should be looking at some information about Payroll Partners. If you're not seeing that, you may have to move your screen around or change your view to speaker or gallery, depending on your screen settings. Today, we will be using the Q&A box, so please feel free to enter any questions that you have there, and Elaine will work hard to answer those throughout the presentation. And then, of course, we will have a Q&A at the end of the presentation to try to answer as many questions as possible. Anything that can't be answered directly or specifically today with Elaine, of course, she's welcome to follow up and have those conversations with you. The presentation will be shared. Afterwards, there will be an email sent out for everybody so that you're able to view that if you need that. And if you're having any trouble with your audio, if there's an echo, you may want to double check and make sure you're not logged into your computer as well as your phone settings. So I'm going to give everybody just a few more minutes, and then we're going to get this started. The slides will be emailed to you afterwards if you'd like. The slide notes, if you notice in the chat section, I'm just answering a question here by Sherry. In the chat box, if you look at the employee retention credit slide notes and click on that link, that's going to provide you with the condensed version of the slides along with some places to take notes. If you need the actual presentation, reach out to me directly and I'm happy to get that over to you as well, or I'm sure Elaine is. All right. Well, thank you again, everybody, for joining and for your patience. I hope everyone's having a beautiful day today. My name is Mia Walker. If you're not familiar with me, I am the Client Engagement Manager with Payroll Partners. Very excited to be here. Payroll Partners, if you're not familiar with us, is a small local provider of payroll, timekeeping, and human capital management resources. And I'm here to help facilitate information like this to not only our clients, but to the community in general. And the reason we're presenting this topic today about the employee retention credit and how it affects churches is because about half of our business is based within non-secular or faith-based entities. And so this is something that's close to our heart, and we do believe it is part of our mission to serve. We've been here in the Arlington area for over 25 years, and we do look forward to your continued support. So today I'm so excited to introduce Elaine Somerville. I'm sure many of you know her. She's with Somerville and Associates, and she is a highly recognized accountant in her field. I would say she's been doing accounting since 1985. She's had her practice in Arlington for over 20 years. And Elaine does focus on nonprofit organizations, specifically in the areas of tax, but she also really has a she has a passion for training and working with churches and nonprofit organizations. So she's a regular speaker for many organizations. She's an instructor for the AICPA. She's also a contributing author to Thomson Reuters' Nonprofit Tax and Governance Guide. It's a mouthful. She's on the advisory board for the Christianity Today Churches Law and Tax team, and she's authored a book church compensation from strategic plan to compliance. That's Christianity Today, and that was in 2018. So thank you so much for being here with us today, Elaine.
Well, thank you, Mia. And I just want to make sure, can you hear me?
Yes, ma'am, you sound great.
Good. Well, thank you so much, Mia. I'm so honored by Payroll Partners to be requested to do this webinar and to join all of you today. I'm excited that we have so many people joining us. I do see that they're having some problems finding all those links in the chat, Mia. So I've just told a couple of them you'll be working on that as we go. And so we are going to talk about the employee retention credit. This is perhaps a bit of a topic that has slipped up on a lot of people for a couple of different reasons. Like so much of what we have dealt with over the last year, tax-wise and the pandemic provisions, things have changed. It's a little bit like following the science. It seems to change on a daily basis on what we can do and not do tax-wise and what benefits are there. So we are going to talk about the employee retention credit today, but let me give you a little background on it. So this particular credit was a part of the CARES Act, which was the second big act that came out dealing with the pandemic, trying to give some relief to employers, especially, and to individuals. So it was first passed in March of 2020. When it was passed, when the retention credit was first given to us, it was prohibited from being used by any employer that applied for and obtained a PPP loan. And for most employers, the PPP loan was more advantageous than the employee retention credit. And so many employers did get the PPP loan that the employee retention credit just fell by the wayside. We just weren't thinking about it. We weren't looking at it. And so the next thing that happened is that the Taxpayer Certainty and Disaster Tax Relief Act, the TCD-TRA, along with a provisions bill in December of 2020 was passed, and it did a major shift in the landscape. That particular bill came out and said, okay, we don't care whether you got the PPP loan or not, we're going to let you still get the employee retention credit. So even though you receive these PPP funds, you can still potentially qualify for the employee retention credit. You just can't use the same money for both. And we'll talk about that again a little bit later. But you can still get it, and we're going to give it more to you. We're going to extend it into 2021. Originally, the CARES Act said this was only a 2020 provision. The next thing that happened, okay, we kind of that's right after Christmas. I mean, it was like right after Christmas. And everybody was at year end. We weren't paying that much attention to it. So we kind of let that slip in. And then the next thing we know, we roll into February. We're still talking about pandemic relief. And the American Rescue Plan was passed in February, and it extended the employee retention credit to the end of 2021. And so now we have not only a new landscape for 2020, we have a new landscape for 2021, and everyone's juggling all these different provisions. So we're going to go through both what happens and how does it apply for 2020 and how does it apply for 2021? Because it would have been just too easy for Congress to have left it the same through 2021. That would have been way too simple. Instead, they have really, while a lot of it is the same on terminology and qualifications in some ways, and then other ways qualifications have totally changed, and the amount of the credit has very much changed. We're going to be looking at both 2020 and 2021. Now, the reason we're going to do that is your 2020 credits are still available to you, and we'll talk about how you can get those. What's the purpose? Well, like most of the pandemic provisions, relief to employers. The Congress wanted to give relief to those employers that really continued to pay people, even though their businesses were decreasing or the government had shut them down, and they were trying to keep their employees on staff or paid, try to keep their commitments to them. And so they felt like this credit would give them the funds to help them do that. So let's first look at eligible employer. One thing I want to say is that one of the terminologies is that an eligible employer has to have a trade or business. So for most of us in the nonprofit world or the church world, we're thinking, well, we don't have a trade or business. What are you talking about? Well, for nonprofits, the way trade or business is referred to or defined and clarified in the frequently asked questions was that it applied to all the operations of a nonprofit organization. So for churches, that would be everything. Nonprofits, that's everything. So don't be thrown off if you hear someone refer to, well, you have to have a trade or business. As a nonprofit, as a church, you do have a trade or business for this provision. So 2020, what's happening in 2020? Well, there are two ways to qualify for the credit in each of the years. For 2020, the first way to qualify for this credit is that your operations were fully or partially suspended due to government orders. These government orders affected commerce. They might have affected your suppliers, your vendors, travel, size of gathering. Somehow you had a government order that affected you. Now, we'll talk a little bit more about government orders when I go into some definitions at the very end. But just know that a government order is just that. It's not a suggestion, it's a must. You have to. This is just good. This is we think you ought to. This would be a mandate from the government. If you weren't under a government order to mandate, so maybe you were an essential business and so you were kind of ordered to stay open, or you continue to operate in some way, but your revenue is severely affected. So in 2020, if your revenue was less than 50% of your revenue for the same calendar quarter, and this is a quarter by quarter comparison, if your revenue was 50% or less than 50% of the same quarter for 2019, you were going to qualify. And we have an example to walk through in just a few minutes, and that may help you. So we either look at revenue, and if you didn't meet this 50% or more decrease in essence, then we were going to look at government orders or government mandates. But it was an or test, and so we could do either one. Now, it's a little tricky in 2020 that actually gave this is when it starts and this is when it stops. And so once you were eligible for the credit in 2020, it would continue until the first day of the calendar quarter following the quarter that your revenue went to more than 80% of a comparison quarter. Once again, just keep thinking we're still comparing to 2019. We'll walk through that in the example also. So it was a little bit of this was your starting point. Now this is your ending point. 2021 comes along, and it was always set to end at December 31st of 2020. 2021 comes along, we extend the credit, but not the same way. It's not the same credit anymore. So once again, how do we qualify in this year? Our operations are fully or partially suspended due to government orders affecting commerce, travel, or size of gathering. That's going to be the same test, 2020, 2021. Here's your different test. And this one, we got a huge windfall because now our comparison on quarterly income is going to be that our income is basically decreased by only 21%. It's less than 80% of the same quarter in 2019. So understand that you're in 2021, we are still comparing to 2019. We never compare to 2020 unless you didn't exist in 2019. And so there's the one option to do that. I've had, for instance, several people had really good first calendar quarters of 2020 until the pandemic hit. And so actually they would have qualified comparing to 2020, but not 2019. In 2021, instead of having the start and stop date, we look at each quarter individually. And so for the revenue test, you look at it and you go, okay, are my revenues less than 80% of the same calendar quarter for 2019? If they are, then I qualify. But if we don't qualify, the IRS, the law says, not the IRS, this is actually in the bill, that we could look to the calendar quarter before this one and see if we qualify. If we can qualify on the prior calendar quarter, then we would still qualify. While these are written two separate ways, the net effect of the wording being whatever the wording is that you kind of end up with a free quarter. You end up a little bit with a quarter that you're really bouncing back, but you get to still claim the credit. So let's look at our examples. So this is the one example we have today, and to work through the eligibility. So let's look at 2020 to begin with. So my church's gross receipts for 2020 are 48% for the last quarter, for the first quarter, sorry, 83% for the second quarter, and 92% of quarter three when I compare them to 2019. So I'm in 2020, I'm looking for basically a more than 50% drop. So in that first calendar quarter of 2020, I get that. I am down, I'm only 48%. So I qualify and my eligibility starts with that quarter. So in applying that, if you just look at the second quarter, it's like, are we going to qualify or not? And so the second quarter is 83%. It looks like I'm not going to qualify, but we're going to qualify until the first day of the quarter following the quarter we go above 80%. So in this example, I'm going to qualify for first and second quarter. First day of the third quarter, third quarter, I'm no longer qualifying. Yes, you're going to have to read this like 8 times before it starts to even begin to sink in, because it really makes no sense. And it's kind of a tongue twister even to try to say this. So understand that there are a couple of there's a really good example of this one in the frequently asked questions that is on the IRS website. And so it kind of lays out 2020. 2021 gets easier to say, at least, even though it still kind of boggles the mind. And that is, I'm going to look at each quarter separately. So I'm going to look at quarter 1, and I'm going to look at quarter 2, and I'm going to look at quarter 3 and quarter 4. So in quarter 1, I look at this and my gross receipts are 48%. So with that, I clearly qualify, because what's my test for 2021? It's only a drop of 21%. So anything it's, up to 79% of my comparison quarter, I'm good. I'm good to qualify. So quarter 1 is eligible. Quarter 2, 83%, on the face, not eligible. But what did we get? An election that said I could elect to look at the previous quarter to see if I qualify for the current quarter. My previous quarter is back to quarter 1, my 48%, so I get to qualify. So quarter 2 qualifies. So under both scenarios, in my viewpoint, you kind of end up with a free quarter. Kind of nice. So just know that you've got to have all your quarterly income laid out for 2019 and then 2020 and 2021, not monthly. This is a quarterly test. So make sure you have the right numbers laid out there. All right. So I see a question come through the chat from Michael, and he's saying, if I get the credit in 2020, am I going to still be eligible for 2021? And the answer is yes. So you're going to be, every quarter you're eligible, you get to claim this credit. But we're going to look at how much the credit is and the limitations on the credit, and they're different also. So what's the amount of the credit? Well, in 2020, it was 50% of eligible wages. Eligible wages were capped at $10,000, and so the credit was capped at $5,000 for any employee that was eligible. So in 2020, no matter how much I had, it was only going to be $5,000 an employee. All right. And so that was pretty easy. And a lot of people, what they're finding is that after we make adjustments for our PPP loan and what we used for the PPP loan, we still have wages left over, mainly a lot of times in that fourth quarter, that we can still get the employee retention credit for in 2020. In 2021, this credit goes to the roof. So now it is 70% of eligible wages, not to exceed $10,000 per employee per calendar quarter. That's right. It's not a year test anymore. It's a quarter test. And this means exactly what you've read, that you probably are shaking your head thinking this can't be true. This means that it's a maximum of $28,000 per employee for the year, if you were qualifying every single quarter in 2021. So to answer Michael's question, can we do both? Yeah, have at it. You sure can. So in theory, that's $33,000 an employee if you were qualifying in all these, under both years to the fullest extent possible. So you see now why all of a sudden, and I think that one of the big changes came so close to the end of the year, and then another in February in the middle of the quarter. And then of course, parts of the country had these horrific storms in the middle of February. And so even the first quarter, this just wasn't clicking in to what it meant to people. I mean, even myself, had going to my fellow colleagues doing payroll returns and everything, all of a sudden we're scrambling going, do we qualify? Do we qualify? And you can't figure out if you qualify till the end of the quarter necessarily. And so, for the first quarter of 2021. So yes, I think we're learning about this, we're realizing what it is, and we're all now trying to get on board. Eligible wages. Those terms, I don't make them up when it says things like that. So what's eligible wages? So according to the law, the pandemic provisions frequently attach the definition of eligible wages to this definition. And it is tied to the definition of wages in IRC section 3121. Okay, so what is that? You're going, that's a fancy code section, Elaine, and I don't know what that means. Well, this is FICA wages. This code section defines what goes in box 3 on a person's W-2. Okay, and so when you're looking at what is subject to FICA, then it goes in box. This is what you're looking at, is what's in box 3 of the W-2. What is that? What else is eligible wages? Well, it's healthcare costs associated with the employees who have eligible wages, and that includes any elected deferrals into a Section 125 plan. All right, so what's that? Then in essence, what we're going to have is, if you have a Section 125 plan and it has a flexible spending account in it, or an HSA that is funded by employee dollars, those deferrals into that plan, that cost, part of the cost of the health insurance that employee pays through that plan, those are all considered healthcare costs borne by the employer for this credit. So they're generally not 3121 wages, which is why that specifically has to be included into this arena. What does this not include? Well, a big one for churches, and this is where a lot of practitioners are going to slip a little bit if they're not familiar with what 3121 does. So in the definition of 3121, it specifically says it does not cover any earnings of a minister in performing ministerial duties. That's why for ministers, we never, ever, ever have them subject to FICA withholding and matching, because legally those wages are not defined to be subject to FICA withholding and matching. So that would be an incorrect thing. So if you're tuned into me now and you're going, we withhold FICA and match it on our ministers. Probably another presentation, but just as a side note, don't do that. That's not the legal definition. So what did this do? And I'm not sure that this was a thought out plan as much as it was a consequence. So in essence, as with the Families First credits, the paid sick leave credits, all of those credits were tied to FICA wages, so they all excluded ministers. So when you're looking at your employee retention credit, you have to exclude all of your ministers and all of the health care associated with your ministers. So that's a big one for people to understand, that we can significantly, all of a sudden, the value of that credit goes down because that may be a huge part of your payroll, especially in the church world. We can't use any wages that were used to justify a PPP loan. Let me just stop this sentence right there. If you put those wages on your application for forgiveness, you're probably not eligible unless you loaded up your application for PPP forgiveness and you have a lot of extra expenses on there. So let's say you just did everything on that forgiveness application because you did it before we got the change in the law. So you put wages on there and you put all your other expenses on there that could go on there, and you have $175,000 of expenses on your application for forgiveness. And lo and behold, you only needed $130,000. So you actually used more expenses on that application than you needed for that forgiveness. Then you can go in, you just can't use the same wages. You also can't come back later and say, well, if I put my rent on there, I wouldn't have needed the wages for on there, and I could have switched things out. In other words, I just put compensation on there. I just put wages on the PPP application for forgiveness, and I didn't go into all these other expenses. And that may be true, but now you can't change it. So you're not changing your application for forgiveness. You're kind of stuck with what's on it. But if it's got more on it than was needed, you can work with that a little bit. Credits that were provided by Family First, which is our sick leave credits and our family leave, emergency family leave credits. Those wages cannot be employee retention credits. That's in the tax world, that's what we would call double dipping, and we're not allowed to do that. An extra one that none of you have ever seen or used probably is the work opportunity credit. That is also not allowable. So if by any chance any of you ever claimed a work opportunity credit, that would not be eligible, those wages would not be eligible for the ERC. Side note, I know this was definitely targeted to churches, nonprofits. I'm just going to put a sidebar in here that if you are a for-profit entity, or if your nonprofit has a unrelated business income, trader business that it's deducting wages on, or you own a for-profit business, it's deducting wages. Any wages covered by any of these credits are not deductible for calculating corporate income tax or income tax. So only that doesn't apply to most of you, but if you are filing any type of tax return, then you would have to make adjustments to what you deduct for wages. This was another change between 2020 and 2021. And that is the definition of what we're going to call our large employer. So what they did is they came in and said, if you're a large employer, you're only going to be able to claim the credit on really kind of the people you paid to work but didn't have a job to do. Like, for instance, if you're claiming under government shutdown, then you could only claim for employees that were affected by that segment of your operations that got shut down. And so that was at 100 full-time employees to get to a large employer. For 2020, we still have similar rules, but our definition of large employer is now at 500 full-time equivalents instead of 100. So large employers got bigger, or maybe small employers got bigger. I'm not quite sure which one that would be, but in any way, shape, or form, it does matter how many full-time equivalent employees you have. So I'm going to just jump over here to Q&A because sometimes it's nice to answer a question as it comes through and not wait totally to the end of the presentation. And I think we'll have plenty of time. Suzanne has asked that she thought that the ERC expired in Q2. Great point to point out, Suzanne, and I think we'll get to another slide that has it on there. But that was what the American Rescue Plan did, is they extended it to December 31st. And so they added 2 more quarters in there. For clarity, can we include premiums paid by employer for eligible employees for health insurance? Yes, that is a health cost. If the employer contributes to the HSA on behalf of the employees, is that eligible? Yes, it is. That is a health care cost. And so you can include those amounts. Nicole has a more specific question about state grant funding and federally funded. I'm going to have to pass on that one, Nicole, because when we get into funding from state and federal grants, that's probably more than I can do off my cuff. This is a great time for me to tell you that on the front slide when it was up, and then at the end on my last slide is my contact email. You are free to email me a question if I don't get to it within the presentation. If I can find a quick answer, I'm more than happy to share it. If it needs more in-depth research, I'm more than happy to convey that it may be beyond what I can just tell you off the top of my head about this credit. All right, so let's talk about claiming the credit. So how do we claim the credit? In 2020, you're going to get all of the credit. We're just going to call it 2 different things because we can't do anything simply, remember? So the credit is first applied against the employer's portion of OASDI. Once again, fancy tax initials for you. That is the Old Age Survivors Disabilities Insurance. That's Social Security, FICA. So in essence, it's like we're going to wipe out the employer's portion of FICA. And then when we run out of employer FICA, we're just going to give you the rest of it. That's called the refundable portion of credit. So it doesn't matter whether you have enough taxes to absorb the credit, you're still getting all of the credit. If you go back and you think, hey, I qualified for the first quarter of 2020, and so how do I claim the credit for the wages between March 13th, which was the enactment date of the CARES Act, and March 31st, those are the only wages qualifying. How do I claim those? Well, those were actually instructed to be claimed on the second quarter 2020 941 because we couldn't rewrite the 941 fast enough to claim them on the first quarter. An interesting note, of all the tax returns that were extended in 2020, the 941 was never extended, even the very first one for the quarter where it was due April 13th. All right, let's see if I can get back to where I'm going here. All right, so that's 2020. What do we look at in 2021? Well, we couldn't even do that consistently the same. And I've been practicing tax law for 30 years, and I'm beyond having to understand that there's always a rationale behind all of this. Sometimes it's like we tell our children because Congress says so. So the first and second quarters of 2021, the credit is first applied against OASDI, the employer's portion of FICA. All right. For quarters 3 and 4, the credit is first applied to the employer's portion of Medicare. Change the game. Once again, we don't have enough taxes to absorb it. It's just refundable anyway. So I don't know why the whole thing wasn't just refundable. I don't know why we felt the need to put the tax limitations in there. I will tell you this. Interestingly enough, that when you prepare your Schedule B, which is your schedule of payroll tax liabilities. That's what helps you determine whether or not your payroll tax deposits were made on time or not. The IRS determined that. The non-refundable portion of the credit is allowed to reduce those payroll tax liabilities on Schedule B. The refundable portion of the credit is not. How they're really going to figure out when your payroll taxes were all due, I'm not quite sure. And I think we're all still trying to figure that out ourselves. But that is the guidance that's out there in the instructions. If you're sitting there going, Elaine, this is great information, but it is May, the end of May, mind you, for 2021, and you're talking to me about 2020 and 2021 that's passed, what are we going to do? Well, if you determine that you can claim these credits, you're going to file amended 941s. That's a Form 941X. Filing simply for this credit is not complicated. The 941X is one of those forms that you only have to change on it the line that changes. And so really just running through this credit on the 941 is not horribly complicated, especially if you're just getting money back. You may need to change your Schedule B. That may be more complicated. And so the complicated part is getting your money. So currently the IRS, this would be a paper filing. Unless there's some more sophisticated software that is submitting it electronically. But in essence, for most of you, it's a paper filing. The IRS is not processing paper well. From the point of the pandemic, in January of this year, they finally announced, they said that they had opened all the mail. At some point in time, they had 6 million pieces of mail unopened. Right after they announced that it was all opened, all the ice storms hit in the South. And then the commissioner came back up and said, oh, no, wait, no, not opened anymore because we shut down 3 servicing centers during the ice storms of February. So what we know, and I was reading on some of my own practitioners' chat lines this morning, as you see, that all of these submissions for the 941X, the 7200, which we'll talk about in just a minute, the IRS is not processing quickly. And so now we're going to talk about if they're not going to process my refund. So your refund claims for 2020, you need to get them in as soon as possible. I would plan on seeing that money 6 months to a year, to be real honest. I'm not sure you'll get it faster than that. We still have some things pending from last July and August. And so just know this is not what you're going to depend on to make your budget next month. Well, can't we claim the credit early? Because you're all saying, everybody says we can claim this credit early. So how do we do that? Well, the IRS's preferred way is you don't make payroll tax deposits, but don't cross credits. For instance, you cannot take a 2020 credit and reduce your payroll tax deposits this quarter with it. Every quarter has to stand on its own. So you can't say, oh, well, I have credits from the first quarter of 2021. I'll reduce my payroll tax deposits now. Don't do that. Please don't do that. That's going to be a huge penalty situation. So all you can do now is reduce your payroll tax deposits for second quarter to the extent you have payroll tax deposits to make. And that's what the IRS prefers that you do. So that's kind of hard if you don't know if you're going to qualify. I mean, that's why they kind of give you that pad quarter. So if you qualified for the first quarter of 2021, that's going to be your fallback quarter for the second quarter of 2021. So you need to just start preparing for that. Small employers, that's less than 500 FTEs, may file a Form 7200 to request an advance payment of this credit to the extent it's not covered by payroll tax deposits. So the IRS has said, use up all your payroll tax deposits first and then file the 7200. You can fax in the 7200, which was the way that Congress basically told the IRS, you've got to get this money out there and it has to be now and fast. Once again, my professional feed that I was on, they have not received any responses from 7200s that were faxed in February. So this is once again not going to be your speedy system. I also commonly get the question, how should I apply for this credit? Should I file a 941X or should I file the 7200? That is not an either or situation. The Form 7200 is your advance credit for future quarters of credits. You can't use it at all for 2020 or a past quarter. Once you use your Form 7200, in other words, you submit that, even if it's not been given, even if you don't have it yet. So you got to the end of the second quarter, you'd filed a Form 7200, the money's not in your bank yet, you still have to say on your Form 941 that you filed the 7200. You have to account for it on there if you use it. Otherwise, everything's messed up in the system. So the Form 941 reconciles your use of the Form 7200. They interplay with each other. They don't stand alone. All right. Let's talk about some terminology. Talked about a little bit along the way. It's always important to know what we're talking about. And so we've got one question from Illinois about suspension of operations. I said earlier it requires a government mandate. I'm going to first address our Texas churches. You need to seek legal counsel before you decide if you're under a government mandate. The reason is that, number one, there's probably a time period in there you were under a government mandate. After Governor Abbott declared you were an essential business, it changed all the mandates. So even if you followed a recommended mandate, it didn't mean that maybe it was applicable to you. And so this is why it's very dangerous to go with the flow, so to speak, to think just because we've been closed down, for instance, we've got a question, what's the effect of Governor Abbott's return to normal, mask order? Well, that's not going to be the point. The point was, were you ever under a mandate to reduce your capacity or to not have services? Or did you follow what was the mandate for other businesses because it was good sense? So the lawyers need to help you determine how that essential business classification affected your suspension of operations. Now we've got a couple, I see one kind of coming into the chat about preschools and kindergartens, and what can happen is that your operations can be under two different mandates. And remember, it also goes to a partial shutdown. So if you had a school and it was mandated to shut down, period, it was a school, then that may be enough to get your whole entity under a mandate order. If you were mandated as a daycare that you could only now have 10 kids in a class instead of the 20 you had planned on, and you don't have room to put 10 kids in a class and spread everybody out, that may be a mandate order that you're under. So it doesn't have to be that you have a mandate order that somehow shut your entire operations down. It can be a partial shutdown. So it could be a capacity shutdown. The other thing I've run into in some states, I have one client that they had campus churches, and their campus churches were in schools and theaters. So when the orders came down from their government officials, they shut down the schools and shut down the theaters. They didn't have a choice. They lost their vendor. That affected their supply chain. So even if they were declared an essential business, their vendor was shut down, and that would then be under this suspension. So if you are going to claim a suspension, I strongly recommend you write a narrative out that specifically addresses the mandate law rules and which ones are which, what dates they were under. I think we have portions of Texas, we are under a total mandate that I think you may have a better success at. I think you have operations that are under certain mandates. And I don't recommend, if you're going to claim it under this, that you attach those to your 941X. I am the person that's like, you give the IRS a concise narrative, tightly formed, you don't put all your verbiage in there. But you have all your verbiage and you have all your support in case it's ever questioned. So with my client that lost their theaters and schools, we have a long by order edict and what happened, how that affected kids ministry, how it affected their ability to have services. You also need to be prepared to tackle how successful you were with online ministry. I'm not going to tell you I have the absolutes in any of these, but that's why I do think that if you have a serious employee retention credit that you're eligible for and you're using the suspension of operations, that you get legal to sign off that your analysis is either so clear cut you can't miss it, or that they agree that that's a defendable position. And so I can't stress that enough. I'm never going to be the professional that says, oh, we have a shutdown order, or they told us we should be 50% capacity. I think it is a much more broad analysis of the factors than that. Let's talk about gross receipts for a minute. So gross receipts is something that churches are not going to understand. That's because we utilize the definition for 990 reporting purposes. And when the IRS says gross receipts for 990 reporting, they mean gross receipts. They mean everything. This is not your budget went down by 50% or 30%. This is your total dollars through the door. That means you're going to look at what went into your building fund, what went into your mission fund, what went into your benevolence, what went into every one of those restricted designated funds that you don't usually consider as part of your budgeted dollars, and add up that gross receipts. You know what else it includes? The proceeds from stock sales. So if you sold investments in order to get money to get through the time, that gross proceeds from those stock sales goes into gross receipts. So be very careful that you're not just looking at so many churches. You run your profit and loss statement when it's printed, it's budget only, because all your other funds are someplace else. Make sure you bring all your gross receipts together, or you won't be working with the right numbers and you won't know whether you had an actual drop or not. Full-time employee, I've referenced it a couple of times with our big and small employers. This is the same definition as is used for the ACA. They just fell back to what we're all used to looking at, and that is an FTE is the definition of that it is an ACA. So you would be looking at those when you're determining that. Great question from Suzanne. She says, do the gross receipts include non-realized gains or losses on investments? And the answer is no. No. Non-realized gains and losses are not part of gross receipts. And thank you, Suzanne, for asking that, because that is a great question. Question from Daryl, what if I had a specific capital campaign in 2019? Do I include that? Yes, you do. So remember that you're including it when you calculate 2019 for your comparison year, your benchmark year, and you're calculating it for the quarter you're trying to qualify for. My last kind of a little bit of a warning is choose your professional assistants wisely in two areas. There have just been a slew of just kind of companies that have popped up to help employers take advantage of all these credits. And this is one of them. A lot of those companies operate on contingency fee basis. And that's something that most CPAs and attorneys are prohibited from working on, except in very specific issues. And so if we practice before the IRS tells us when we can have a contingency fee arrangement with a client. You won't see them as much from CPA firms who are not willing to walk that line. So my kind of just my heads up, my red flag about contingency fee organizations is making sure that those fee arrangements should have some sort of sliding scale or cap, something that if I have retention credit claims that are going to be $100,000 to $200,000. So if it's just a flat fee basis, someone's trying to charge that client to do this, then that could quickly get very large if you're talking about 5% or 10%. And you want to recognize it may not take that much time. You make the best decision, but if I were looking at contingency fee arrangements, I would be thinking about what's the overall, the larger the claim, the larger the fee gets, the more it may not be a reasonable fee arrangement. If so, go back to the company and talk to them about it. Just say you have ask for a cap or ask for a sliding scale. Be fair to them, but make sure it's a fair arrangement to you. So it's just something to think about in selecting your professional. The next thing to think about in selecting your professional is making sure that you're selecting someone who's used to working with churches. I am very concerned that some of these companies cropping up out there will not understand what eligible wages are, and that they would still have churches claiming on ministers' wages. I know that I have already received one question that said, are ministers' wages for the employee retention credit? And I said, no, they're not eligible wages. And the response back to me was, our denominational lawyer says they are because they're on a W-2. That's not correct. That doesn't have anything to do with this test. And so be very cautious of using professionals that are used to working with ministers and churches, such as Payroll Partners, our host today, who are very experienced in working with ministers and churches. Their fellow firm, PSK, excellent CPA firm, very used to working with churches. There are many out there that what they do is work with churches, and they do understand the very unique payroll aspects of ministers. And that's who you need to seek to find to assist you if you're a religious organization trying to maneuver some of this so that you don't get led astray. The last thing any of us want is for your church or organization to receive $100,000 credit and then have it audited and challenged. One thing I did not put in the PowerPoint slide, it is in the article that's been written. Filing for this credit extends the statute of limitations to 5 years on that 941. So recognizing they were going to get a lot of them, I guess, the IRS or Congress authorized that statute to be extended. And so if you are doing anything with this credit, you need to change your record retention for that to know that your statute is now 5 years, not 3. So that means you're going to want to keep all those documents longer than you might normally keep payroll tax support information, potentially. Let's see. Donna's asked, where or how did we report the reduction in gross receipts? Donna, you don't have to. That's not something they're asking you to report. That is something that they are asking for you to be able to document and be able to confirm that and prove to them that you had that reduction. So that's going to be in your backup documentation, but not necessarily in your documentation that is going to the IRS or is it reported on the form. I have a question in the chat for coming through. Are ministers' housing allowances allowable wages? No, nothing you pay to your minister, no health benefits for your ministers are eligible wages. You have to totally take them off the table. And so you're not going to be able to do any of that. Anne has waited patiently throughout the whole presentation on a question from her Illinois, where she hails from there. And that is, she had 5 phases that they basically had some levels at. And yes, and if your governor applied a mandate to your churches that they had a size or gathering issue, then that strengthens your case that you're under a government mandate. And that size or gathering issue may definitely qualify you. Once again, I say, you really need to look at how many programs did you successfully transfer to online. What I'm finding is, are our worship services successfully transferred? Our children and youth programs did not successfully transfer as much. That's kind of my feedback from my clients. But I think you need to, what I've had my clients do is address, you know, why we still had services every Sunday, but what part of our operations did this really affect and how did it affect them? Put that in your narrative. I'm encouraging you to write that narrative now, not that you're going to send it to the IRS, but that you are going to basically have it available in the future. You want to do it now when everything's fresh in your minds. You can have access to all the orders. You can review the orders. You can have all that information, make a good decision now, and have that documented for any future challenge. Because 3 or 4 years down the road, who knows who's going to remember what happened in 2020 by that time, or 2021. So my contact information is on this slide. I am so appreciative of Mia and Payroll Partners to inviting me to do this session today. I know it's been a lot of information, but I hope it's been helpful information to you. And I really hope that your church is not leaving money on the table.
Thanks so much, Elaine. We were really grateful to have you come and present this information to us. And so thank you so much for your time. Please feel free to reach out to Elaine with her contact information, and I'm sure everyone will be seeing and hearing more from her soon. If anybody is interested or hasn't seen our exciting mobile timekeeping app that includes GPS, I'm happy to show that to you. Just want to put a plug in for that, as well as our electronic onboarding system for human capital management. So again, this is Mia Walker with Payroll Partners. I appreciate everyone's time. I don't think we have any more questions that we need to address, so we're going to end this on time, and a video will be sent out afterwards. Look forward to our next presentation. We don't have a date solidified yet, but we'll be announcing that soon. And I personally look forward to hopefully speaking with all of you at some point in the near future. So we'll see you at our next webinar. Thanks, Elaine.
Thank you, Mia.
Bye.
Bye, everyone.